Hi everyone, welcome to this session of understanding loan write-off. So before we go into the details of loan write-off, let's do a bit of a recap on loan provisioning. So in the last video, we had seen what a provisioning means. It means that the bank recognizes a loss of the loan ahead of the time. So for example, if you have booked a loan for $100,000 and you have the loan asset at 100,000, you set aside a certain percentage, say 10%, and provision it, which means you expense 10,000, which is 10% of that loan, assuming that the loan might go bad in the future, which means the borrower may not have the ability to pay back the loan. Now, as and when the loan gets into NPA state, the provisioning percentage might increase from 10 to 20 and so on. So if you look at the normal loan life cycle, initially the status of the loan is always normal, as it is being paid every month on the due date. It can go into subs, which is substandard, if there is a delay in payment between 1 and 30 days. The second important stage is the delinquent stage, wherein the loan is not being paid regularly by more than 30 days. So it could vary between 30 and 180 days, wherein the NPA status or the non-performing asset status goes from doubtful to loss. Now, what happens if there is complete stop of payment from the borrower? The borrower is unable to pay anything and then the loan is arrears for more than, let's say, 180 days. Then the bank takes a decision to write off the loan. So write off the loan is an accounting process. We will see more of it in the next slide. But let's understand that loan write-off is more of an accounting process, but doesn't mean that we will not still try to collect the loan from the borrower. We will still try. However, for all accounting purpose, it's written off. So when do you write off the loan? It is written off after the borrower has defaulted on the loan prepayment and there is very low chance of recovery. Usually it is between 180 days and 365 days of no repayment from the borrower. This is an accounting process, as I mentioned. It doesn't mean that the account cannot be collected or recovered. And in case of a write-off, any collateral which was given by the borrower is confiscated until the borrower makes the repayment. Alternatively, the collateral is auctioned off to recover the loan amount. So what is the accounting behind write-off? Now, as we know, when the loan is booked, you actually have the loan asset sitting in the asset side of the books. And then when you do a write-off, it goes into expense. So you are expensing it. So the asset becomes zero, the expenses becomes 80,000. So that's first part. Obviously, the interest accruals are stopped in the loss date itself. But write-off, definitely you should stop accruals, and furthermore, you might actually reverse whatever accrual you would have done of the interest. So why is the loan written off? First of all, it cleans up the balance sheet as the NPA reduced. The one loan gets off the balance sheet from an NPA position. And more importantly, because you have expensed it out, your net profit reduces, thereby decreasing the tax liability. Then this write-off is not to be confused with waive-off of the loan. Waive-off is a completely different process, which is a complete cancellation of the loan, which means the borrower is free from that particular debt and no legal action will be taken. So, for example, governments periodically do a loan waive-off, right? Whenever there is a natural calamity like a cyclone or a famine, etc. And if there is any collateral, the ownership papers will be duly returned to them. Hope this gives you a very good idea of what loan write-off is all about. Thank you for watching this session.